Yeah, it's a difficult and pretty volatile environment to be investing in at the moment. I think we have quite a few sort of destabilizing influences that are impacting markets. So we have obviously fiscal consolidation and austerity measures being introduced in a number of countries, which is depressing growth rates. We have deleveraging ongoing. We have a lack of credit expansion at the moment. And we also have banks looking to recapitalize their balance sheets. And on top of that, there's obviously the imbalances at the moment in terms of government financial positions and growth rates between the core and the peripheral countries as well. So that all adds up to quite a challenging economic environment for the Eurozone, with a low to no to slightly negative growth environment that we actually have just now. So that's the overall environment, but we would emphasize that there are also some more positive aspects that we'd like to draw attention to as well. And they would include the fact that the corporate sector in Europe is in a very strong position from a financial point of view. Balance sheets are strong, interest cover is high, and free cash flow generation is also at a high level. So the corporate sector is actually very robust just now across most sectors of the market. And then the valuations are also very attractive, we believe. And in some cases, and depending on the metric that you choose to look at, valuations for European equities are at multi-decade low levels. So we think valuations attractive, the corporate sector is in good shape from a financial health perspective, and also a lot of companies that are listed in Europe generate a large amount of their revenues, a large proportion of their revenues and profits from outside of Europe itself. And some of those companies are actually continuing to report very good results at the moment. So there's a mixture of challenges from the economic perspective for the Eurozone economy, but also still, we think, a number of opportunities within the stock market just now. I think the real threat would be a sort of disorderly breakup or beginning of the breakup of the euro, the currency itself. And obviously Greece has been an important focus point in this regard. And our core scenario is that Greece does not exit the euro within the near term at least, but it is a possibility. So the real risk, I think, is that a contagion effect kind of develops from that situation. We don't think that the euro will break up. Our core view is that it holds together, and we think that policymakers would become very active and seek to take some quite aggressive measures where signs of real contagion to start to emerge. So we, as I said, a lot of European companies generate a high proportion of their revenues and profits from outside of the Eurozone. In aggregate, about nearly half of the revenues of the European corporate sector come from outside of continental Europe and the UK. So there are a lot of globally exposed companies that are continuing to do very well just now, and we are investing in quite a few of those in our portfolios, particularly companies that are exposed to or can benefit from the trend towards growth of consumption in some of the emerging economies just now. And they're present, there's quite a few examples where those companies are present in the European market in the consumer staples and in the consumer discretionary sectors. So consumer staples companies like Unilever or British American Tobacco would generate over half of their profits from emerging markets. And in the consumer discretionary area, we have some companies in Europe particularly exposed into the luxury goods area, which are doing very well just now. So there are some of the opportunities for us. Also, actually, in some of the peripheral countries themselves, which on paper are not the first place you would go looking for investment ideas at the moment. We do have some holdings in peripheral countries just now in our portfolios. For example, in Ireland, our funds are quite heavily overweight in that market. And Ireland's actually been the best performing European market over the last 6 months, and in fact the best performing market in the world over the last 6 months. So even though the economy is troubled and not necessarily really showing great signs of improvement at the moment, there are companies listed in the Irish market which are very good, well-managed international businesses which have been performing very well, and we've been benefiting from that in our portfolios. And we also have some selected holdings in Spain and Italy as well at the moment.